Want to trade like a pro? Imagine being able to spot the key zones where the market is gearing up for a big move. These aren't just random lines on a chart. They're the levels where big players are positioning themselves. In this video, I'll show you a proven strategy with a 65% win rate that will help you identify supply and demand zones and use them to your advantage. You'll learn how to pinpoint these areas, time your entries correctly, and take profits where most traders fail. If you're tired of random trades and want a clear, effective system, this is for you. Ready to see the market the way professionals do? Let's go. To understand this trading system, you need to follow 2 steps. Step 1. Identify the key structural points on the chart. Step 2. Find a structural demand zone or a supply zone. The structure helps us accurately determine the trend and the points after which the trend is either confirmed or reverses. Alright, step 1. Let's define the structure and the structural trend. Let's look at an example. Imagine we're looking at a chart like this. Let's mark the structural highs and lows on it. If the price breaks a high, it means we are in an uptrend. If it breaks a low, we are in a downtrend. In our example, the price is moving up and breaking the high, which means we have a bullish trend. For the trend to change, the price must break the red line. Only then will the trend become bearish. It's easy to notice that the structural low is the lowest price between 2 structural highs, the high that has already been broken and the new high. As long as the structural low is not broken, we are still in a bullish trend. Now we know which points are structural and which are not. We needed this to identify the key points after which the trend either continues or reverses. So, if the trend is bullish, the point where the trend could reverse, the red line from the previous example, will be defended by big capital. That's because if the price crosses this level, the trend will shift and start moving downward. This is the foundation of our trading strategy. Step 2. Identifying the structural zone. Alright, now we know how to identify the structure. Let's mark the key points. We can see that the trend is bullish because the price has broken above a structural high. Now we're interested in the structural low. As we already know, the structural low is the lowest point between 2 structural highs, the broken high and the new high. If the price breaks below the structural low, the trend will shift from bullish to bearish. That's why big capital will defend this level. If the price approaches this range, major players will start buying to prevent the trend from reversing. This is our demand zone, and this is where we look for a long entry. We place a limit buy order just before the zone, with a stop loss below it. The take profit is set to maintain a good risk-to-reward ratio, ideally 1:3 or better. So, when the price reaches the zone, it gets bought up to prevent a trend reversal, and we take our profit. But wait a minute, there's one very important rule. Without it, this trading system won't work. The zone must not be part of a trend line. As we know from classic technical analysis, when the price approaches a trend line and breaks through it, this can trigger a strong price movement in the direction of the breakout. So, if our demand or supply zone is part of a trend line, it means that when the price reaches our zone, there's a high chance the trend line will be broken. And that's a risk we don't want to take. That's why we avoid trading in such situations. Alright, so here's the chart we're looking at. Let's mark the structural highs and lows. We can see that the price has broken through the structural high, which means the lowest price between these 2 highs will be our structural low. That's where we'd typically expect a price reversal. But there's one key detail we need to pay attention to. We can see a trend line, and that changes everything. If the price breaks through this trend line, it's likely to keep moving lower because trend lines often act as a magnet for price action. So even though this zone technically meets the structural criteria, it's not a good setup because it's part of a trend line move. Key takeaway: a zone is invalid if it's part of a trend line. Let's quickly go over the rules for marking zones based on highs and lows. We'll use a demand zone as an example. The bottom of the zone is simply the lowest wick of the candle. Whether it's bullish or bearish, it doesn't matter. The top of the zone is usually either a consolidation area or the smallest bearish candle closest to our low. For demand and supply zones, this rule works the same way but in reverse. This trading strategy works across different markets, including crypto, forex, and stocks. The optimal time frame for this strategy is 1 hour, but it can also work on 15-minute charts depending on market conditions. Now let's look at some examples. We can see how a structural high breaks the previous structural high. We mark the zone between these highs and place our position. We place a limit order above the zone, set a stop loss below it, and target a take profit 3 times the size of our stop loss. The price fills our limit order, and we secure a solid profit. Another example. The structural high breaks the previous structural high, confirming that we're in a bullish trend. We mark the zone between them, place a limit order, and wait for it to get filled. Our take profit is successfully hit. Another example. We can see a strong uptrend. We mark our structural highs and identify the structural zone. Then we place a limit order, set our take profit and stop loss. Once again, we secure a profit. Here's another scenario. The price has been trending strongly upward. We identify the structural highs and mark the key zone. Then we place a limit order along with a stop loss and take profit. The trade moves as expected and we secure another profit. For a downtrend, this trading strategy works the same way as it does for an uptrend. Here's an example for a downtrend. The market has been in a sharp downtrend. We identify the structural lows and mark the key zone. We then place a limit order, along with a stop loss and take profit. The price moves as anticipated, and we lock in a profit once again. In this short example, the market is showing a clear downtrend. We identify the structural lows and mark the key zone. Then we place a limit order with a stop loss and take profit. The price reaches our target, and we secure a profit once again. For successful implementation of this system, we've outlined a few key points. Clearly define the structure. Don't mistake genuine structural points for mere local extremes. Never trade in zones that are part of trend lines. Always maintain a risk-to-reward ratio of at least 1 to 2, preferably 1 to 3. Be patient. Sometimes you might have to wait hours or even days for the price to reach your zone. Even a simple strategy can yield solid profits. If you'd like to see more videos on trading strategies, be sure to subscribe to our channel, hit the like button, and share this video. Hope to see you again soon. Goodbye.